Welcome to the channel. My name is Frank Mularcik, and this is the first video in a series in which I'll be analyzing stocks suggested to me by my subscribers. If you want me to analyze a particular stock, just leave me a comment down below, or you can join the Discord as well and suggest it there. So the first stock that I'll be analyzing as suggested by a subscriber is United Rentals Inc., ticker symbol URI. United Rentals is the largest equipment rental company in the world, with most of its operations in the US and Canada and limited presences in Europe, Australia, and New Zealand. The vast majority, about 87% of their revenue, comes from renting out their equipment, and that rental equipment is split into the following categories. So the first is industrial and non-construction rentals, which are rentals to manufacturers, energy companies, chemical companies, and companies in other industrial sectors. This category accounts for about 48% of rental revenue, and the next category, which accounts for 47% of rental revenue, is commercial construction rentals, which are rentals related to the construction and remodeling of offices, lodging, hospitals, and other commercial buildings and spaces. And the final 5% of rental revenue comes from construction and renovation of residential homes. So that is the 87% of total revenue that is rental revenue. And then the remaining 13% of their revenue comes from sales of some rental equipment, sales of some new equipment. They sell some contractor supplies, and also they have services revenue related to repair and maintenance of equipment as well. Looking at United Rentals' recent operating results, 2022 was a great year for them. For the year, total revenue was up 20% year over year to $11.6 billion. And on the bottom line, net income was up about 52% to $2.1 billion. In December of 2022, URI completed the acquisition of Ahern Rentals, which was the 8th largest equipment rental company in North America before the acquisition. And URI paid about $2 billion to acquire Ahern, and they took on about $1.5 billion of debt to do that. What I think is very interesting actually is that they acquired Ahern for about 1.3 times book value, which seems like a pretty good deal to me. So Ahern's book value was actually about $1.5 billion, and they only acquired them for about $2 billion, which gives that transaction a 1.3 times book value valuation. And for the first quarter of 2023, revenue was $3.3 billion, which was an increase of about 30% year over year, and rental revenues themselves saw an increase of 26%, which was partially due to the acquisition of Ahern, but including Ahern's rental revenue from 2022 in the comparison, the pro forma revenue increase was still 16.6%, which is great to see. The interest expense notably is starting to increase a bit because of increased debt and higher interest rates, but that is a bit expected, like I said, because of the interest rates, and I don't think it's really too severe at this point. Net income for the quarter was $451 million, which was an increase of 22.9% year over year. Looking now at the balance sheet, we can see that they have very little cash on hand, but current assets total $2.6 billion, which is down just a tiny bit from the end of 2022. The good news, though, is that those current assets are greater than the current liabilities, which are sitting at $2.3 billion right now. Moving to debt, I would say debt looks high to me right now, with total debt sitting at $11.6 billion when we add up about $11.5 billion of long-term debt and $156 million of short-term debt. I'm definitely not super knowledgeable about the ins and outs of the rental business, but it makes sense to me that higher relative levels of debt in a business like this would generally be okay and not as much of a concern. So although the debt is higher than I would generally like to see, I think in this case, I'm not too concerned about it. And it will be important, I think, though, to pay attention to things like the interest expenses over the next few years. And new debt will likely be at much higher rates than we've been used to over the past few years. So those interest expenses are likely to rise. Shareholders' equity has also been increasing pretty nicely over time, despite the fact that they are continuing to buy back shares. And this shareholders' equity number increased by about a whole $1 billion in 2022 alone. So overall, I think the balance sheet is pretty solid. Not much really to worry about, but it would definitely be prudent as an investor to keep an eye on the debt levels and interest expenses over time. When it comes to dividends, United Rentals is a newborn. They just started paying dividends in February of 2023, just a few months ago, and right now, assuming that they continue paying the same dividend amount quarterly, their dividend yield is 1.36% with a payout ratio of about 19%. And as a dividend growth investor, that's a truly fantastic payout ratio, which will give them plenty of room to grow the dividend, hopefully in the future. And like I said, URI is brand new to the dividend game, but they are no stranger to returning value to shareholders. They have had a very strong record of share repurchases in the past, and they actually paused that share repurchase program over the last few years because of the pandemic and inflation and stuff like that. But along with the dividend announcement at the beginning of 2023, they announced a commitment to restart that share repurchase program and buy back $1 billion of stock in 2023. And they are right on schedule with that plan, having repurchased shares worth $250 million in the first quarter of 2023. When it comes to valuation, the first thing I like to look at is the PE ratio. And right now, URI is trading at a PE ratio of around 14, which is pretty much in line with its 10-year average PE of 14.8 that we can see here. Usually I'll use a few more years of PE ratio data when I'm looking at this chart here, but in 2009 and 2010, URI wasn't profitable, so the PE ratio was essentially 0 or negative technically. And in the next year or so after that, the earnings were extremely low, so that gave them a very high PE ratio. So I just took off those first few years of data. And right now this data is just for the past 10 years, which I think is perfectly fine. And comparing them to their peers as well, the industrial sector has an average PE of about 18, and the business services industry has an average PE of about 17. So when compared to their own historical trends and their peers, URI seems to be around the fair value, if not a little bit below, I would say. The DCF calculation for United Rentals is actually pretty interesting, but ultimately I'll explain in a minute why I don't think it's really all that meaningful for this company. So the fair value that I calculated for URI was $243 per share when a 7.5% required rate of return was used, and that gives a buy price of $219 when a 10% margin of safety is applied. When a 10% required rate of return was used, I calculated in that case a fair value of $106 per share, which gives a buy price of $96 per share with that 10% margin of safety. This makes URI look massively overvalued right now, since the current share price is $445 per share. However, there are a few caveats that I think are important to consider. So first of all, the free cash flow is generally inconsistent and not really at a similar level to net income. When you're doing a DCF calculation, it's really optimal, and it works best when the company's free cash flow is generally in line with the net income, and that's really not the case for United Rentals. Another thing to note is that the calculated present value of the free cash flow minus the outstanding debt, which is just another way of saying what the fair value market cap would be that I calculated, that number was about $7.3 billion in the case with the 10% required rate of return. And this is barely above the company's shareholders' equity, which is right now at about $7.1 billion, which means that the DCF calculation is basically saying that the company is pretty much worth only the difference between the assets and the liabilities. And in the case of a profitable company like URI, I think it's pretty easy to argue that the company is worth a lot more than the difference in the assets and liabilities, because they are using the business to produce revenues and produce profits that can be taken out of the business or reinvested back into the business. So I would say the business is worth a lot more than the shareholders' equity, which is really not what the DCF is saying. So like I said, I don't think this DCF is really all that meaningful in determining a fair value and a buy price for URI stock. Overall, I think United Rentals is a very exciting company that could potentially be a great investment. They are consistently growing their rental fleet and have fantastic revenue and net income growth. And they also have a good history of share repurchases and recently started paying a dividend, which will hopefully be a consistent and growing dividend in the future. The balance sheet definitely looks a bit more heavily weighted with debt than I would generally like to see, but I think in the case of URI and their business model, I don't think it's all that big of a deal. But like I said, I think paying attention to interest rates and that debt load is certainly important if you're going to be an investor, and just keeping an eye on it over the next few years. Right now, they seem to be in the range of their fair value. I think they would be sort of attractive below maybe $400 per share, and I don't think it would really be all that unreasonable for them to get there fairly soon, or not necessarily soon, but it wouldn't be all that difficult. It wouldn't take all that big of a move, since, they've been on an absolute tear the past month or so. But for me personally, I would like to do a bit more research into the company, understand the business model a little bit better, and have a better grasp on my idea of the fair value before I would want to invest in the stock, just because it is a newer company for me and I'm not as familiar with it. But let me know what you think of URI stock in the comments down below, and I'm sure some of you are more familiar than I am, so I'd love to hear your thoughts and insights. And if you did enjoy the video, make sure to subscribe to the channel so you don't miss out on future videos, and I will see you all in the next one.